Recessions are a normal part of the business cycle and the economic cycle. We may be slightly overdue to have one at this point, although the last one that we had took very, very long to recover from. The Great Recession that started back in 2008 took a full decade to recover from, which is also very unusual.
Back when I was a new real estate investor, Rick, I didn't know to look at the broad economy at all. I was more concerned with if, say, on a vacant unit that I had the drywall texture just right to try to attract a new tenant ASAP. Now, that surely matters, but time gave me the perspective to know that what matters more is to have a local stable of tenants that are capable of paying the rent. And that's what matters more. So with that in mind, where would you like to begin?
Yeah, I think that's great counsel, and it's really important for investors or even somebody looking to buy a house to understand what's going on economically, both across the country and in their region. So why don't we start by taking a look at what's going on in the economy? There's been a lot of conversation about potential recession. We can talk a bit about that.
Yes, that dreaded R word may very well come up. That thing that we've all been waiting for, but has never happened.
Well, don't count your chickens just yet, but let's see what's going on in the economy.
Well, because on average, recessions do happen every 5 years. It's just a normal part of the business cycle.
Yeah, that's important to keep in context. I'm glad you brought that up. Recessions are a normal part of the business cycle and the economic cycle. We may be slightly overdue to have one at this point, although the last one that we had took very, very long to recover from. The Great Recession that started back in 2008 took a full decade to recover from, which is also very unusual. So we'll take a look at some of these cycles and see where we are today. Keith, the basic metric that most economists look at when they're trying to figure out the strength of the U.S. economy is something called the gross domestic product, the GDP. We track that to see if it's growing, if it's declining. The technical definition of a recession is 2 consecutive quarters of negative GDP growth. And there's been a lot of talk about the GDP slowing down in the U.S., but really it's been mostly talk. In fact, if you look at the last quarter we have data for, which was the fourth quarter of last year, you can see that the GDP grew by 3.2, 3.3%,
Right.
which was a much higher number than what most economists had forecast.
That resilient economy with a low unemployment rate, jobs being added, and productive growth in the GDP.
Yeah, we're going to get to all of that, and it's a great point. If you look at what makes up the GDP, about 2/3 of it is comprised of consumer spending.
Right.
So typically, when you see strong GDP numbers, your consumer is doing pretty well, and a lot of this probably has to do with consumers still having money to spend from the enormous amount of stimulus that the federal government poured into the economy to help prevent a recession or depression during COVID. About $15 trillion in all of stimulus that was sent out to consumers and businesses alike. And that's probably helped us weather the storm of what normally might have been a slowdown in the economy. We are, however, Keith, in a globally interconnected economy. And it's important to note that not all of our peers are doing quite as well. Canada may already be in a recession. The UK is almost certainly in a recession. The Eurozone barely escaped going into recessionary numbers in the last quarter. And even markets like China aren't doing as well as expected. And I'm not saying that to gloat about how well the US is doing. I'm saying that as sort of a warning that if we do get into a situation where it looks like there's a global recession going on, it's very unlikely the US will come out of that untainted at all. So it's something to keep an eye on as we move forward.
Right, 100%.
You mentioned unemployment a couple minutes ago, Keith, and that's one of the other economic metrics we check. Unemployment went all the way up, and I say that facetiously, to 3.9% in the most recent numbers. Full employment is considered to be anywhere at 5% unemployment or lower. And we haven't been at 5% unemployment probably since about 2016, with the exception of the blip we had during the COVID pandemic when the government shut things down and we had a huge increase in unemployment temporarily. But we are continuing to see very, very strong job numbers, both in terms of these low levels of unemployment and in terms of job growth. The January and February numbers, again, caught the economists who come up with these consensus forecasts by surprise. In January, about 350,000 jobs created. In February, about 250,000 jobs created. And I should put an asterisk on some of these numbers. When you hear politicians talking about all the jobs they've created over the last few years, keep in mind that during the COVID pandemic, we wiped out about 22 million jobs virtually overnight.
Yeah.
And a lot of the millions of jobs that have been created over the last few years were really those old jobs being refilled. But that said, we filled most of those within about 2 years, and we have continued to create jobs since then. In fact, we have more jobs than we have people looking for work. There are
Right.
about 8.5 million jobs open, about 6 to 6.5 million people looking for work.
You could almost
Uh,
think of this as an overemployed condition.
it almost is. In fact, in most cases, not all cases, but in most cases, somebody who doesn't have a job right now just isn't looking for a job right now. And these are not all service level jobs. That's the other pushback I get when I'm out talking to groups sometimes. Oh yeah, but not everybody wants to work at Starbucks. Well, first of all, you get pretty good benefits at Starbucks, free coffee, healthcare. But let's not do a Starbucks commercial. These are government jobs, they're manufacturing jobs, they're construction jobs. They are sometimes service level jobs, but these are jobs across the board. And because there are more jobs available than people looking for work, we're seeing wages go up. The average hourly wage across the country last month was over $29 an hour, which is the highest it's ever been. And if you look at wage growth on a year over year basis, it's running at about 5%. And really, Keith, this is the first time in a number of years that we can say with certainty that wage growth is actually running at a higher pace than the rate of inflation.
Right.
So
And
not
that really matters. That really helps pay the rent. One thing that detractors say with the unemployment rate, you talked about them not necessarily being consolidated in the low paid service sector area, is that a lot of people lament, well, aren't many of these part-time jobs? What are your thoughts there?
there are a probably historically large number of part-time jobs, but we also have an awful lot of people who have opted out of full-time work for a variety of reasons and are thrilled to be able to pick up some money working in the gig economy. So whether they're
Right.
driving for Uber or Lyft, they're doing door dashes or something else that's a part-time job that they're doing just to either, in some cases, kill time or to make a little bit of extra money. This isn't an economy where the majority of part-time workers are in part-time jobs because they can't find a full-time job. That's simply not the case, and the data doesn't support that.
Now, if you, the listener and viewer here, are wondering, well, this stuff doesn't apply directly to me. I'm good. I'm secure in my job. Maybe I don't even need a job. Keep in mind that we're talking about the financial condition of your tenant today.
Yeah, when I'm talking to real estate investors in general, I know that you were talking about drywall earlier, and sometimes you really can't see the forest for the trees. You're kind of overwhelmed, or you're not sure where you should actually be looking. I tell them in many cases to pay less attention to home prices and rental rates and more attention to some of the underlying fundamental economic conditions. Are you in a market where population is growing or declining? Are you in a market where there's job growth? Are you in a market where there's wage growth? If you're in a market where the population, jobs, and wages are all growing, you're going to be in a pretty healthy market for real estate, whether it's owner-occupied properties or it's rental properties. On the other hand, if jobs are leaving your market, if wages are going down, if population is declining, those are warning signs, and it might be an indication that that's not a good market to start investing more in. So everything we're talking about really does get connected back to the housing market, whether it's rental housing or owner-occupied housing. And it's important to see these trends for what they are.
And of course, we're talking about these factors on a national level. As we know, all real estate is local, and our audience is often interested in studying a metro market before they decide to invest there. So, on that more regional level, Rick, or local level, do you have any favorite resources or websites or apps that you think are important for prospective investors to look at first within a certain region or MSA?
Well, you can find a lot of local market data on some of the free housing sites that are out there. The Zillows, the Realtor.coms, the Homes.coms of the world. If you go beyond the basic home search, or if you dig deep into some of the information that they provide on local markets within that home search, you'll find a lot of information there. There are third-party companies. There's a company I'm familiar with that works mostly with realtors, but has a lot of data that investors would probably be interested in. It's called Keeping Current Matters.
Yeah.
Uh, they do an awful lot of reporting on this. But if you really want to do your own research and you don't mind doing a little bit of digging, I find the Department of Labor and the Census Bureau and the Bureau of Labor Statistics, all government entities, have just copious amounts of local market information you can find, down to what does the local pipe fitter earn on an hourly basis in Peoria. There's all of that data out there for free on these government sites. You just have to be willing to do a little bit of research and dig through those sites.
Right. And sometimes the government websites don't exactly present their information in a beautiful, graphically rich way, but this is part of your research. Some people don't realize that FRED, the Federal Reserve Economic Data, has an awful lot of regional and local information, not just national information as well. Well, thanks for sharing some of those resources, Rick, and where you like to go and look. That can really help our audience. What else should a real estate investor know about today's overall economy?
So we talked about consumer spending and the reliance our economy does have on consumer spending. And one of the things that I'm watching fairly carefully right now is an apparent disconnect between consumer confidence and consumer spending. So if you go back to when the pandemic hit and the lockdown occurred, consumer spending obviously fell off a cliff. There was just nothing to buy. And consumer confidence took a major hit with the announcement of the pandemic. Consumer spending, as soon as the lockdown was over, started to come back strongly and has never slowed down. It's at an all-time high today. Consumer confidence, on the other hand, was battered a little bit by subsequent waves of COVID, by a threatened government shutdown in Washington, by the war in Ukraine, by the more recent war in the Middle East. And so the concern here is that if consumer confidence doesn't come back, we might see spending revert to the mean, and actually, as economists would say, and come back down, which would cause, at the very least, an economic slowdown, and at the worst, probably a recession. So it is something we're keeping an eye on. Consumer confidence has been improving a little bit lately, but historically, it's gone hand in hand with consumer spending. And that simply hasn't been the case in recent months. So it is something we're keeping an eye on.
Now, one might wonder, how do you measure confidence? Well, there are various surveys out there. And Rick, the way I think of it with consumers is that consumer confidence is more of a leading indicator, and then the actual consumption is more of a trailing indicator.
Yeah, I completely agree with you. And the sentiment index that I follow most closely is one that's put out by the University of Michigan,
Yeah.
and it's been out there for decades. So there's an awful lot of history that goes with it. And generally speaking, you're looking for on any index, you're looking for a number that's around or above 100 because that usually is your baseline. And some of the more recent months, we've seen numbers down in the 50s and 60s. Now they've been trending up, as I said, in recent months, but that's something that's reported on very widely by the press. We were talking about sourcing things for investors, and I have to tell you, the just doing a basic Google search for something like, what's consumer confidence like today, you'd be surprised the rich information that you can pull just from Google, that you can start to find some of these sources online. But that is one thing that we're watching. And Keith, I think it's important to break out a little bit in more detail how consumers are spending or what they're spending with. And these are potential red flags for the economy. Consumer credit card use, the amount of debt on credit cards surpassed $1 trillion in the third quarter of last year for the first time ever. And it got close to 1.2 trillion in the fourth quarter. That's an awful lot of credit card spending, regardless of what you want to talk to me about with inflation adjusted dollars. It's still $1 trillion. And that happened at a time when credit card interest rates had soared because of what the
Yeah.
Federal Reserve was doing. So you're talking about people spending $1 to $1.2 trillion on their credit cards when the average interest rate on a new credit card issued was between 25 and 30%,
Gosh.
which, by the way, is a high enough number that it used to get you arrested for usury. And apparently now
Yeah.
it's the new normal and it's okay. But this is a concern. And one of the big concerns is because the cost of living has become so high and so difficult for so many families. The worry is that people might be starting to use their credit cards to make ends meet, to buy basic necessities. That historically has not been a story with a happy ending. So we are watching credit card use. We're also watching personal savings rates. So when the government stimulus came out, we saw savings rates at all-time highs. We then saw savings decline rapidly to all-time low levels. They've recovered a little bit, but they're still on the low end of things, historically speaking. So the same worry here, Keith, which is that we're worried that families might be dipping into personal savings in order to make ends meet. And that combination, there's some research that suggests that on average, the US household has more credit card debt than they have savings. And that's just not a healthy ratio for anybody to have.
Yeah,
Uh,
America has very much of a live for today mindset, I think. So therefore, was it pretty predictable that after the COVID stimulus payments, that savings levels probably would drop?
Yeah, it's just that they dropped farther than what we had hoped they would. We're going to talk about inflation in a second. I have a bit of skepticism about some of the inflation numbers that we see reported from the government because of what they include or exclude, or some of the facts, some of the data is trailing by a long time. So out of frustration, I created my own CPI. It's not the Consumer Price Index; it's the Costco Price Index. Um, and I look at one of my leading indicators is salmon because I buy my salmon at Costco. And a year ago, that salmon cost $9.99 a pound. Today, shopping at Costco, that salmon costs $12.99 a pound. That's not a
30%.
that's a 30% lift. And for all the talk we hear out of the administration about gas prices going down, I can tell you that where I buy my gas at Costco, it's a couple dollars more a gallon than it was just a few years ago. And I say this, with a little bit of a chuckle, and I say this knowing that it's a nuisance for me, but I've been blessed, and it's not a life or death decision for me. But there are families out there who are deciding whether or not they can buy salmon this week, and I would submit that on average, your rental family's income is lower than your owner-occupied house's family's income. And so for all of your listeners who are landlords, this is something to be paying very close
Yeah.
attention to. Despite the fact that inflation is coming down, keep in mind that these inflation rates are on top of very high prices that we have as a result of the previous cycle of inflation. So it's going to take a while, even with wages going up, for those households to catch up here. And the hope is that wage growth will continue to outpace inflation growth long enough that they'll be able to do that.
Yes, that's a positive trend. Yeah, Rick, as long as in your Costco price index, Costco doesn't try to skimpflate and replace your wild Alaska caught salmon with Atlantic farmed salmon. I'm sure you're going to be paying attention to that as well as you fill your own shopping basket and come up with what's really happening with inflation. Because for those that believe the CPI, it's been reported in the low threes lately, and CPI peaked at 9.1% almost 2 years ago in June of 2022.
And what the Federal Reserve has done is unprecedented.
Yeah,
We've only ever seen rates go this high this quickly once in the last 50 or 60 years. That was back in the 1980s when inflation was really in a runaway mode and out of control. And normally what the Federal Reserve does is very methodical, very thoughtful. They'll raise the Fed funds rate a quarter of a point. They'll sit back and wait to see what happens. They'll raise it another quarter point and give it some time to take effect, and so forth and so on, until they feel like inflation is under control, and then they'll drop that Fed funds rate. In this case, they've admitted a few things that probably took a lot for them to say out loud. They admitted that they underestimated how high inflation would get.
sure.
They admitted that they underestimated how quickly it would rise, and they also admitted that they underestimated how difficult it was going to be to get it under control. So when it did peak at about 9.1% a couple of years ago, they took unprecedented steps in terms of the size of rate hikes, and the rapidity with which they raised the Fed funds rate. And now they're in a position where Inflation is trending more or less in the right direction. It's in the low threes, as you said. It has not come down as much in the last couple of reports as they would like, and that's probably going to result in them holding the Fed funds rate at its current level for at least the first half of this year before they start doing rate cuts, because the last thing they want to do is cut too soon and see inflation start to come back up.
About 1 month ago, I did an episode titled Why the Fed Should Not Lower Rates. Rates are historically normal and the economy doesn't need the help. So if we do have this dreaded R word, this recession, the most convenient tool for the Fed to use is to cut rates. So we don't want to use up that ammo while we're still in a good position like we are today.
Yeah, I don't disagree with you. And there were some economists and mostly Wall Street who had been predicting a Fed rate cut as early as March and then
Right?
six over the course of the year. And I thought they were all crazy.
Right?
And I've been saying at the earliest May. Now I think it's probably not until June. The rates are a little higher than historic averages. So I could see maybe three rate cuts this year, maybe four if the economy slows down significantly. But we're certainly not going back to the zero rates that we had for a few years. And I think the Fed will be very cautious and reserved in its approach to scaling back the Fed funds rate. One of the side effects of what they did is they cast a lot of uncertainty and doubt into the financial markets, which have caused mortgage rates to skyrocket, which have caused private lending rates to skyrocket for your listeners who borrow from private lenders. And I don't think we see those rates start to come down significantly until after the Fed does its first Fed funds rate cut. I suspect, and so far I've been right, that until we see that rate cut, we're going to see mortgage rates on a 30-year fixed rate loan kind of bounce back and forth in a very narrow band between about 6.75 and 7.25% for the next few months. And that's really where they've been since January. And I think that will continue to be the case until we see that first rate cut, at which point the market will probably say, okay, they're serious. Now we can have that sigh of relief. And
Right?
then we'll see a slow and gradual reduction in mortgage rates. I did want to touch on two things related to the Fed actions and the current economic issues, Keith, because
Please.
I often get the question about likelihood of a recession. If you go back in history, all the way back to World War II, not counting this cycle, the Federal Reserve has raised the Fed funds rate 11 times in order to get inflation under control. 8 of those 11 times, they've wound up overcorrecting as they raised the rates,
Right?
and that steered us into a recession. The 3 times that didn't happen, the 3 times they executed a soft landing, not a recession, all 3 of those cycles had something in common, and that was that the Fed didn't have to overcorrect because they started early. They acted proactively when it looked like inflation was getting started, and they were able to keep inflation under control without a drastic increase in the Fed funds rate. This cycle, they've already admitted that they waited too long and inflation got higher than they expected. And because of that, they've had to raise the rates more quickly and more dramatically, again, than anything we've seen in the last 40 or 50 years. So historically speaking, it would seem more likely than not that we'd see at least a mild recession. And the people who say, well, if we would have seen one through this cycle, we would have already seen it, often overlook the fact that it can take 24 months after the Fed's rate hikes are done to see the full effect on the economy.
Economies
So
are complex and cycles move slowly.
they do. So historically speaking, that's one thing I look at. The other, and without getting too inside baseball for your listeners, is something called a yield curve inversion.
Yeah,
And
I've
that's
discussed that.
when the bonds markets sense a disruption in the force and think that Darth Vader may be hitting the economy. But basically, it's when the yields on longer term investments like 10-year Treasury bonds switch places with the yields on shorter term investments like 2-year Treasury bonds. So the yield on a 2-year investment is actually higher than the yield on a 10-year investment. And when you have that inversion, that's what they call a yield curve inversion. And the last 8 times that's happened, we've had a recession follow. Not always a long, drawn out recession, but there's always been a recession. And this particular yield curve inversion cycle is one of the deepest and longest ones we've had in a long time. And again, using history as a precedent, there doesn't seem to be a really good reason for this cycle to behave differently than the last 8 have. Having said all that, we may get lucky. The Fed may pull a rabbit out of its hat and actually execute that rare soft landing instead of a recession. If they do, we'll still feel the economy slow down. That's almost a given. And if they don't, if we do have a recession, every economist I speak with tells me the same thing, that it's likely to be a very short, very mild recession because all of the economic fundamentals underneath are still very, very strong. And, employment, wages, productivity, and so forth and so on. So likely to see some sort of slowdown this year, Keith, whether it turns into an actual recession or is just very, very slow growth. That's the most likely scenario for the rest of 2024.
Well, Rick, as we wind down here, the last thing I'd like to ask you about is in a recession, what typically happens to real estate? Because you and I both study history, and something that I often say here on the show is oftentimes you need to look at history over hunches. For example, I think it's easy to have a hunch that when mortgage rates rise, well, home prices are definitely going to fall. No, actually, if you look at history, when mortgage rates rise, home prices typically rise because rising rates typically mean the economy's strong. And another one is when home prices are up, well, a lot of people think that others want to then jump into the housing market and buy when they see that prices are up. So then when home prices are up, well, that means rents must fall since everyone's buying. But no, these two things typically move together, home prices and rents. It's about history over hunches. So with that in mind, talk to us with your historical research on in recessions, what typically happens to the real estate market?
Typically, home sales go up from the beginning of a recession to the end of a recession. And in fact, with the notable exception of the last recession, the Great Recession, housing has very often helped the economy recuperate from a recession and recover. And that's particularly true in the new homes market. Home prices also typically go up from the beginning of a recession to the end of a recession. So you could have some short-term disruption. You could see home sales volume or home prices dip slightly at the beginning of a recession. But historically speaking, in every recession except the Great Recession, we've actually seen both home sales and home prices go up. And to your point, higher mortgage rates do not historically equate to lower home prices. What they do equate to is home prices going up at a slower rate. This last cycle has been very unusual because historically we've never seen mortgage rates double in a single calendar year until 2022. And in fact, that year rates didn't double in a calendar year, they doubled in a couple months.
And tripled overall.
And they tripled overall. So if you look at that, we did see home prices actually decline in some markets, although nationally the number never went negative. And we saw home price appreciation drop off pretty dramatically, but still stay positive on a year-over-year basis. So it's been kind of interesting. This has been a very unusual cycle for a lot of reasons, but historically speaking, you're spot on. A recession does not spell doom and gloom for the housing market, whether you're talking about owner-occupied homes or rental properties.
Rick and I talked about the general economy today. Next week, Rick is going to join us again, and we're going to focus squarely on the real estate market. So no long goodbyes, Rick. We'll see you next week.
See you soon, Keith.
You can watch this one next.